Donald Trump's return to Washington promises an economic rush, tax cuts, spending plans, and consumer relief. But there's a catch, an $8 trillion addition to our debt, interest payments approaching $1 trillion, and just 14% of the federal budget available for cuts. So as this high-stakes economic experiment unfolds, what is the year ahead going to look like for business owners? We're going to break it all down for you right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us. Here in the studio with me today is Paul Shao, Asset Allocation Strategist with the CIO Americas team. Paul, great to have you back.
Nice to be here.
So, now we're a couple of weeks after the election. We're starting to wrap our hands a little bit around what Trump 2.0 might look like. And I wanted to kind of start with you and getting your thoughts on, we know what's coming out of the last 4 years of the Biden-Harris administration, now going into Trump and Vance. What is the new administration inheriting from the previous one?
Right. From an economic basis, actually, Trump 2024 looks somewhat similar to Trump 2016, where he's inheriting an economy that's in a more mature profile of the cycle, where unemployment rates are getting lower and things are actually quite good. The year ahead report published by CIO, we're calling it the Roaring 20s. We're already, about 4 years through. And we're really seeing a period where growth is much better than the last cycle after the financial crisis. Right now, we're growing above trend around 2.5%. Inflation is around 2.5%. So that means a real 5% economy. And we haven't really seen that since the 1990s when productivity was rising. And it might continue with the advent of AI and continued adoption for that. And not only that, we actually had the Bureau of Economic Analysis look at the numbers about consumers over the last year. And they did a revision showing that consumers are actually much better capitalized in terms of their balance sheets than before. So this above-trend growth has the potential to continue next year, even though it might be running at a slightly slower pace than 2024. With all this being said, this is all before any potential expansionary fiscal plans that the Trump 2.0 administration might bring.
Right.
So that's the picture that we're looking at.
Right. Good. That's a great way to kind of broaden it out a little bit. But going deeply, or maybe more specifically into some of these campaign conversations, and you might call them promises from Trump and his supporters, they were talking a lot about tariffs. And even today in the news, we're seeing that they're already announcing percentages for countries like China, Mexico, Canada, some of our biggest trade partners. Knowing what we know about tariffs and how they potentially could be inflationary, what should investors and particularly business owners be on the lookout for as they prepare for potentially these tariffs hitting these countries?
That's a great question, and I think a lot has been promised throughout the campaign season. And since the election is over, now we're taking a more sober look into what Trump's fiscal plans might be. And broadly speaking, we're putting them in three, pretty broad buckets. Right? 1, tariffs; 2, taxes; and then 3, immigration. Right? In terms of the tariff front, I think just like before, a lot has been said by Trump. We're going back to potential policy by tweet. But right now, markets haven't been affected too much by it. So they're still very much in wait-and-see mode. They're wondering whether or not this is just an opening move in a grand negotiation tactic, which is not off the table as well. And I think that some of the chatter is a lot of world leaders would like to cut a deal with Trump even before tariffs might happen. So we think that this might be a little less disturbing to the overall economy than initially thought. What's more interesting, as you can see in the chart here, is that these are the potential impacts of what could Trump's tax policy be, and we think an easy win could be extending his initial policy of the Tax Cuts and Jobs Act of 2017. That's supposed to expire quite soon, so an extension of that would be a logical thing to do for the second administration, or rather his second term, to do at first. And then look at immigration plans. Right now, we're already seeing immigration slowing down as the labor market softens up. So having more restrictive immigration right now, it might have had a more disruption effect earlier on this cycle, right after the pandemic, when you had a lot of businesses hiring very fast, so less supply would have constrained the amount of labor that was able to get to hire. But now that you see the labor market softening a bit, and if immigration slows or even reverses, it's less disruptive because we're already in a pretty tight labor market.
Right. What's interesting is when you kind of look at some of the different variables and even maybe some of the caveats here, as we have a chart that you put together talking about how tariffs could potentially lead to weaker growth and higher inflation, which means we are going to be very closely tied to everything that Jay Powell and the rest of the Federal Reserve are going to be saying as we go into 2025 regarding rates. So if rates still are on the path to continually come down, as we have here at CIO, we expect another 25 basis points at the next meeting in December, plus another 100 next year. How should business owners be thinking about that rate environment as we see it potentially not changing from what our call was just a couple of months ago?
I think that's a great question. Right now, our call is unchanged. We still expect 100 basis points worth of cuts next year. But when you have a rather tight economy that's growing above trend and you want to stimulate it through fiscal expansion, whether that's more tax cuts, less stringent regulation, tariffs to some extent, all these things, as you pointed out, are inflationary. So that limits the amount of rate cuts that Jay Powell can do. And I think markets have already reacted to it. Just a couple of weeks ago, I think futures pricing for rate cuts next year wasn't too far off of our call, about 100 basis points. Now it's about half, with markets expecting only 50 basis points next year compared to our call of 100. So that's something, the policy path and the timing of it is something that I'm sure the Federal Reserve, as well as investors, and we, frankly, are watching out for it and how it'll impact the markets for next year.
Right. And back to what you had before with that chart about the fiscal policies and the deficit, it looks like we might potentially see $10.5 trillion in further deficits. And the question then would become, what do we think about how worried we should be as investors, or how worried business owners should be if we see the deficit continue to widen at that rate?
Yeah, that's a good question too. And I think an increasing question that we're finding our clients asking us is, what is the path of debt sustainability in the U.S. and how much is too much? As we saw government debt really expand, especially since the financial crisis, but especially after COVID, as fiscal response tends to be a way to limit the impact of these disasters. All these plans that, if come to fruition, as this graph shows, would add trillions to the debt over the next 10 years. What we should keep in mind is what's the pathway, the legislative pathway to get there, and if deficit hawks from the Republican side will even consider tempering some of the expectations.
Right.
So that's something worth keeping in mind as well.
Right. Again, unknown variables that are ahead of us. We don't know exactly how it's going to be legislated.
Right. But when we think about just overall debt sustainability, the way we like to think about it in CIO is that think about it more of a chronic disease like diabetes than a heart attack that's acute and debilitating. If a debt can be managed for the foreseeable future, so long as you have these nominal growth rate keeping up with being higher than interest payments. So long as that keeps up, then we're still on a path to sustainability, in our opinion.
Right. Great. Thanks, Paul. So just as we're wrapping up, as we're talking about here, our CIO Year Ahead report is about the roaring 20s, 4 years into the decade as we are. Where do you see the investment opportunities for the average investor, given our stance on where we see the rest of the decade going and what we expect from Trump and his 2.0 administration?
Right. Right now, it looks like, just like the first administration, it's very America first led. So the Trump administration, I think, will tend to look at the stock market as a real-time indicator of his approval, of his approval rating. And we think that the most exciting opportunities in AI tend to be in the U.S., and that's part of the reason why the CIO still views tech as most attractive. So I think with continued growth, with opportunities in AI, I think, and earnings still matching expectations, I think that justifies a call of overweight tech for quite some time.
Terrific. Paul, thank you very much. And I know we're still putting some charts up there about the tariffs, and that's a bigger conversation that I'm sure we're going to get to throughout the rest of this year and into next year, once we even get more details about what those tariffs could potentially look like. But thanks for taking us through. This is a great rundown. Good to see you.
My pleasure. Thanks for having me.
Thank you. Paul Shao again from the Chief Investment Office here at UBS. And for more information on anything coming out of CIO, you can visit our website at ubs.com/views. Plus, you can follow us on social media. We're on all the major channels, including Instagram. Follow us at UBS Trending. Lots of content there for you. And as always, if you have any questions about what Paul and I spoke about today, make sure that you are talking with your financial advisor. Until next time, I'm Anthony Pastore. We wish you all a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.